which is great. I want to go to the third challenge now, and you say it's the number one mistake business owners make in acquiring funding. What is that? What is that number one mistake?
So most businesses, a large majority of these businesses, whether they're startups or expansion, put the family finances at risk. And a lot of times when it's startup, they put their home up as collateral, they take a second out on their home, they take their personal credit cards, their personal savings, worse yet, they borrow from retirement accounts or kids' college funds to put it into the business because they're going to make all this money and they're going to one day pay it back. And the challenge is when you mix the family finances with the business finances, it doesn't always work out the way you hoped. And now if the business doesn't work out, the family finances suffer. And so our goal is to separate the personal credit from the business credit so that if things don't go as well, the whole family doesn't suffer. Now the retirement fund is not diminished. Now the kids' college funds are not next to nothing where they ruin their chances.
Wow. You know, I got to say, as an entrepreneur of many years and seeing people in business, that has got to be, I agree with you, the number one mistake. And the terrifying thing about that is if somebody doesn't come to you, it's too late. They've already burned all those personal options. Those are all gone. When we come back, we'll be talking about how Corporate Credit Concepts actually has a money-back guarantee to its clients like no other funding company that we know of. We'll be right back in 60 seconds. Welcome back to Leading Experts. I'm here with Chad and Trent Lee, founders of Corporate Credit Concepts. And Chad, Trent, we had our trivia question here, and that trivia question was, how many business credit bureaus are there?
Really, there's 4 main business credit bureaus that we focus on. Those are the 4 main ones that lenders, the majority of lenders, look at and want to see profiles and scores and ratings with. There's some other smaller sub-business credit bureaus that will come in time naturally as you build business credit with the 4 main ones.
I want to cover the 4th challenge, and that's that half of all small businesses fail within the first year, and 95% of all businesses fail within 5 years. Why is that?
Well, it's interesting. You might think, well, that must have been a bad business or a bad businessman, but that's usually not the case. You may have seen, and some of our viewers may have seen a business locally that seems to be busy. My wife and I have gone through this. We've seen a business that was real busy, it was good, had good quality product, and after 3 or 4 years it's gone. And we would ask the question, well, it was a good product. We liked going there, and we weren't the only ones. There was a lot of people there. Why is that business gone? Mm-hmm. But we find out that you can be a good businessman. You can have a good product, but usually the reason that most of those companies will fail is because of lack of financing. They don't have the financing that they need. People think of the financing they have at the beginning to get started, but what they forget is they need financing when they need to grow or expand. And that's usually what happens. You can have a business, get it off the ground. Some will fail during that because they don't have the proper financing. And others will get it off the ground, get going, and they'll have good customers, good product, and good business, and they'll be running it well, and then they'll need to grow or they'll need to expand. They don't have the financing to do that, and they have no choice but to go out of business. They weren't prepared.
Mm-hmm. You know, I got to say, that's one of the big differences I see when a Fortune 500 company goes into business. They put the financing in place, and they have the wherewithal to not just start, but to grow and endure and maintain. Mm-hmm. And I think you're right. I think the missing piece is what you guys do, and all of a sudden then the longevity can come. They can make it past that first year, past those 5 years to a real entity. I wanted to talk about the 5th business challenge, and that's once a business decides they need credit and they apply for credit, then what? What happens then, typically?
So once a business realizes and understands the benefits of building business credit, the challenge now is doing it the right way and building it the right way, establishing it the right way. Here's the one risk that most people don't realize. You and I have, let's say on the personal credit side, what's called the Fair Credit Reporting Act. It protects us. If something is negative, that's inaccurate on our personal credit files, we have the ability to dispute that, and the bureaus by law have to respond and within a certain time frame have to respond. There's a law protecting us. Now, here's the challenge that comes on the business credit side. The Fair Credit Reporting Act does not regulate the business credit bureaus. So not knowing how to establish your business credit properly, doing it the wrong way, trying to do it too fast, trying to shortcut the process, you run the risk of what they call being red flagged or being put in the high risk category. And here's where this really matters. If your business is put in the high risk category, if it's red flagged because you did something whether you knew it or not, there's no law on the business owner side that protects them so they can go and dispute that. And so it's really vital to make sure you follow the process, you do it the right way, you don't try and shortcut the process.
Well, and I guess the big key is that if you do this prior, you've got it kind of lined up. You're not going to get in that position. Is that right? If you're a new business starting out with you guys, you eliminate all that possibility.
Correct.
Okay.
Absolutely.
All right. Well, that brings us to our sixth challenge, and it's one that virtually every business falls into. All of a sudden, they get there, they're ready for the money, and now they start looking for it. Too late. Is that right?
That's right. We've heard the adage before, when you need the money, the banks aren't going to give it to you.
Yeah.
And so if somebody comes to a bank and they're behind on their bills, they have no money in their bank account, and they're in trouble and need money, it's too late. They're not going to get it. So the best time is definitely, like what you say, is if you don't need it, that's the time to build it up. Most people wait until the time that they need it. And that's why we want to do this early. Preferably before you even get into business, but at least before you get desperate and you're not worth the risk that the bank is going to take. Come to us or somebody, get that credit file built up. Get all those business lines in place when you don't need them, because there will be a day when you need it. You need to expand, you need to grow, you need to make payroll, a number of things. You have it in place already. You did it 6 months ago, you did it 2 years ago. Maybe you never need it, but you have it in place. But you get it in place when you don't need it.
Yeah, absolutely. We've heard that before. And the seventh and final challenge correlates to that. What is that one? The last challenge.
Building business credit takes time. Just like it took some time to establish good personal credit for you, it takes time to establish business credit. And there's no way to speed up time, really, is what it comes down to. You can't establish business credit today and hope to walk into the bank next week and say, look at my business, I'm credible, I've proven that I handle credit responsibly, when you just established it last week. So as we mentioned before, the time to start building business credit is well before you need it, so you can build up that history and you can walk into the bank and show a longevity of history that your business can handle credit responsibly with some history, instead of trying to rush the process because you've got a cash flow need next week.
Which makes it virtually impossible to get it solved. Is that the case?
Very hard.
Yeah, that makes sense. And tell me about this. I researched on this. This is something I found fascinating about within your book and what you do. You have a trademark term that is unique to corporate credit concepts. Tell me about that.
So the term's business credit asset. And while we focus and we help clients build business credit, the key really is not just building business credit. Of course, we want to build them good files and good scores and help them get financing, but we want to make sure that the long-term goal, the big picture, is seen by the client. So it's not just about how much financing we get for the client, it's that now they've got the file to go and get more financing next time they need it, and they don't have to come back to us, they don't have to go back to a broker. They've got, and their business can stand on its own 2 feet and get financing and not have to pay anyone for it. And the key to this is building business credit. That business credit file becomes an asset to the company because it's attached to the company, not them personally. So let's say the business owner a couple years down the road wants to sell the business, and for whatever reason, that business credit file, that history is sold with the business. It's an asset of the company. It actually increases the value of the company.
Yeah, and that makes a lot of sense. If you think about it, if you had a company that has the ability to borrow $10 million, that's a powerful asset. I mean, that is really, your business becomes then like a credit card for $10 million. I mean, really, it's almost whether you're doing business or not, the ability to borrow $10 million is, like you say, truly an asset in itself.
Absolutely.